Taxes. First up, the thing that makes you question capitalism every 2 weeks. Picture this. You just survived a brutal month flipping burgers at McDonald's. You're exhausted. You check your email. Congratulations. You've been paid $2,000. You check your bank account. $1,456. Wait, what? You scroll through the pay stub like you're reading a crime report. Federal income tax, state tax, Social Security, Medicare. It's like the government's running a subscription service you never signed up for, and the cancellation button doesn't exist. Here's the deal, though. Taxes are basically the cost of civilization. You pay and the government builds roads, funds schools, makes sure your local taco truck isn't serving food poisoning, and sends billion-dollar missiles to countries you couldn't find on a map. But taxes come in different flavors. Income tax hits the money you make. Sales tax hits the money you spend. Capital gains tax hits the money your investments made while you were binge-watching Netflix. The government takes a piece of every dollar. Then there's Social Security and Medicare. Social Security is basically the government forcing you to save for retirement. They take your money now and pay it back when you're old. Medicare is health insurance for older folks and people with serious health issues. And then comes the fun part. Filing your taxes. The government already knows how much you owe, but they make you guess anyway. If you guess right, cool. If you guess wrong, well, hope you like letters from the IRS. But here's the thing. Countries with higher taxes generally have better quality of life. So yeah, it sucks. But it could suck way more. Speaking of places that take your money. Banks. You walk into a bank, hand over your cash, and the teller smiles and says, "We'll keep this safe for you." You walk out thinking your money's sitting in a vault somewhere, guarded by lasers and a dragon. But in reality, that money's already gone. Most people think banks are just big safes, but they're not. They're middlemen, financial matchmakers. When you deposit $1,000, the bank immediately takes $900 of it and loans it to someone buying a jet ski. This is called fractional reserve banking, which is a fancy way of saying they only keep a fraction of your money because they're betting not everyone will show up at once asking for their cash back. That is, unless it's 2008, when everyone did exactly that, and the whole system nearly collapsed. Banks make money by lending your money at a higher interest rate than what they're paying you. You're the supply. The borrower is the demand. The bank is the middleman taking a cut. But why do you even use banks? 1. Convenience. Swiping a card beats carrying around a suitcase of cash. 2. They literally pay you interest to hold your money. Not much, but still. 3. It's safer. Your money in a shoebox can get stolen. Your money in a bank? Insured up to $250,000 by the government. So yeah, your money's not in a vault. But at least it's not funding someone's jet ski without insurance. Interest. You borrow $1,000. You pay back $1,280. Why? Interest. It is rent for money. When you borrow, you're paying for the privilege of using someone else's cash. When you lend or save, you're getting rewarded for being patient. There are 2 types. Simple interest is straightforward. Here's your fee, thanks for playing. Compound interest is different. It's when the interest you owe starts earning its own interest. It's like financial inception. Let's say you have a credit card with 20% interest. You miss a payment. Now your interest is stacking on interest. That $12 burrito you bought, it just became a $50 regret. On the flip side, invest at 7% annual compound interest, and your money starts duplicating itself. $100 becomes $200, then $400. Then one day you're old, rich, and a little smug about it. Interest is the silent engine behind both wealth and debt. In loans, it's the slow burn that turns small mistakes into financial disasters. In investments, it's the time bomb that turns small wins into massive wealth. The hack? If you're paying interest, kill it fast. If you're earning interest, let it sit and multiply. Interest is either your worst enemy or your best unpaid employee. The choice is who's collecting it. But here's the problem with letting money sit. Inflation. You grab a bag of chips, open it, it's already half empty. You check the price tag. 30% more than last time. You've just been hit by inflation. It is what happens when money slowly loses value. Not overnight, not dramatically. Just a slow, quiet erosion. Your $5 bill is still technically $5, but now it buys less ramen, less gas, and doesn't stretch as far. What causes it? Sometimes everyone just has too much money. Imagine 2,000 people want a $500 TV, but there are only 1,000 TVs available. The store goes, everyone wants this? Cool, that'll be $800 now. Sometimes it's supply chain issues making production more expensive, so prices go up. Sometimes it's just expectations. If people think prices are rising, they spend money faster, which drives prices up even more. It's a self-fulfilling prophecy. A little inflation is normal. Even good. 2% a year? Fine. Predictable. But if it spikes, savings die, wages lag. Your money becomes worthless toilet paper. That's when the government steps in. They raise interest rates. When borrowing gets expensive, people spend less. Spending drops, the economy cools, and inflation chills out. It's basically economic whack-a-mole. And when they cool it off too much, recessions. A recession is when the economy shrinks for at least 2 quarters or 6 months. One day, everything's fine. You've got a job, bills are paid, you're planning a vacation. Then suddenly, layoffs. The stock market's tanking. Your company's restructuring. In a recession, jobs vanish, companies cut costs, and everyone hoards cash for necessities instead of buying stuff they don't need. Why does it happen? Could be high interest rates making borrowing too expensive. Could be a global crisis, war, pandemic, a rogue cargo ship blocking a canal. Could just be the economic cycle doing its thing. Boom, peak, bust, reset. Think of the economy like a party. During the boom, everyone's dancing, drinks are flowing, music's loud. But eventually the lights flicker, reality hits. Someone checks their bank account, and suddenly the DJ's playing sad, lo-fi beats about corporate downsizing. Recessions don't last forever. They're resets. Painful, but temporary. Governments lower interest rates, send stimulus checks, and hope people start buying overpriced coffee again. Eventually, spending returns. Businesses rebuild. Growth resumes, but not without scars. And your ability to survive a recession often depends on credit scores. Your credit score is a shadowy algorithm that knows your name, your address, and how many times you paid your credit card late in college. It's a 3-digit number that decides if you get a house, a car, or a soul-crushing 27% interest rate on a new TV. And here's the kicker. It's not about wealth, it's about trust. Lenders want to know, if we give this person money, will they pay us back? The score ranges from 300 to 850. Below 580? You're a walking red flag. Above 750? You're radiating adult credibility. Most people are stuck between 640 and 790. How's it calculated? Payment history. Do you pay on time? This is huge. Credit utilization. Are you maxing out your cards or staying under 30%? Credit age. How long have you had accounts open? Credit mix. Cards, loans, mortgages. Variety helps. New credit. Too many recent applications? Red flag. To increase your score, you need to pay on time, keep balances low, and not open too many new accounts at once. Your credit score is like a pet dog. Ignore it, and it poops all over your financial life. Take care of it, and someday it might help you buy a house. You can have zero debt and still have a terrible score if you have no credit history. The game is rigged, but if you learn the rules, you can rig it back. But before we talk about building wealth, let's address the elephant in the room. They're the financial concepts that run your life, explained in under 10 minutes. If you want a part 2, hit that like button and subscribe for more content that'll actually change your life.